Hey everybody, welcome to our passive education on rent roll analysis. We're looking at what our group looks at when we analyze rent roll for a self-storage facility. And some of the things that we're going to go over today is we're just going to consider that when we look at a property, there's a bunch of different unit sizes. So we have 5 by 10s, 10 by 10s, 10 by 15s, 10 by 20s, whatever it might be. We look at all of the rent rolls. So that's just basically a snapshot of what everybody's paying and occupancy. Today, we're going to go over just one unit type. So in this case, we're going to go over a 5 by 10. So we're going to just go through one analysis of what we do when we look at the rent roll and how we can derive value on increasing rents. So you're going to hear a theme, which is on the last 3 webinars we talked about, where we look at market studies. So it's really important to understand what the market's doing and what the competitive rates are. So in this case, 5 by 10 units. So you may ask, first thing you want to know is how many 5 by 10 units are at your property. So in this case, we're going to use the number 100. So we have 100 units that are 5 by 10 units. And then the next thing you want to look at is what the average rate is. So you look at all of the units and you see what the average rate of those units are. So let's just say for this exercise, the average rate is $50 per unit. So some might be 52, some might be 48, but at the average out of 100 units, the average is 50. And then you want to look at what the operator is, or what that facility is charging customers that come in the door. So if they are currently charging 60, let's say, that is a gap in how many units are in the unit pricing. So what we do is we calculate, okay, the operator on their brochure when you walk into the facility is charging $60. That might be their standard rate, but their average collection is $50 a month for that unit size. So in this case, we have calculated, if you take 50 divided by 60, an 83% economic occupancy. So right here, our economic occupancy is 83%. So that might be an opportunity, because if you can increase the $50 a month average to closer to 60, you can generate more revenue and you can generate more valuation for your property. So the next thing that we do is we say, okay, we have 100 units of 5 by 10s. We're averaging $50 a month. Our standard rate is 60, so we have an opportunity there. But what is the market doing? Is the market at 45 or is it at 70? So in this case, let's just say we go out to the market and we see that the market's charging 70 for a 5 by 10, and that gives us an opportunity. So here's our market rates at $70 per month. So we might say, okay, now what do we do? So how do we take that market difference, our standard rate difference, and what we're actually getting today when we're analyzing the rent roll, and create value for an investor? So what we might want to do is we might want to say, okay, it makes sense to make the new rate perhaps, or the targeted rate in our pro forma, $62 a month. So maybe we might say that the new rate might be 62. The market is getting 70, so we're still below market rate, but we're increasing that rate based on what we have today. So the market is okay with $70, so we're going to increase it to 62 to be conservative, right? Because remember, your underwriting file wants to be conservative in how you project your numbers to make sure that we hit our targets. So when we do that, we're going to increase the number of units, the 100 units, right? So $12 is the average increase over 100 units. So we have 100 units increasing by 100 units increasing by $12. So we have $1,200 a month of increases, or $14,000 of NOI. So $14,000 is our NOI. So we simply took a new rate of $62. We said that's $12 increase over the 50 average here. 12 times 100 units is $1,200. over 12 months equals 14,400. So now we know that the NOI, or the net profit that we'll get for the year, just on this unit type is an additional $14,400 if we increase the rents on all of the, if we increase on the 5x10s. Now, what value does that add to the property? Well, that depends on the cap rate. And the cap rate is a bit subjective, but there's always market standards for asset types and markets on cap rate. In this case, we're going to say the cap rate is a 6% cap rate. So if you take the NOI increase in that rent increase that we do, and you divide it by the cap rate, we get a $240,000 increase in the property value. So again, we had, and you know what, I forgot to fill out this block, 14,400. So overall, when we're looking at rent roll, we have a 5x10 unit here. We have 100 units in our rent roll. Their average rent, when we average them all out, is $50 a month. The facility is advertising that they're charging 60, but they're only actually getting 50, right? Representing an 83% economic occupancy of what they're charging from. We went out, we studied the market. Market says, hey, everybody's charging 70, right? So we're already way under market value. And we said, okay, we conservatively think we can make our rate 62. Now, we always give ourselves a period of time to increase rates. So if the operator is saying they're going to increase rates on the first month, probably not practical. We usually pro forma rents going up over 18 months or 24 months. $12 a unit on the increase over 100 units, that's $1,200 a month, or $14,400 of NOI. And if you want to calculate how that increases facility valuation, you take the 14,400 divided by 0.06 for the cap rate, and that increases your facility's value by $240,000. So I hope this was insightful. We'll look forward to seeing you guys tomorrow. We're going to talk more about underwriting and some of the things that we do to increase property values, and look at rent roll to determine if it's a deal worth pursuing. I appreciate your time and have a great day.